Dumelang. I will do the cash flow statement, and the cash flow statement is all about the cash inflows and the cash outflows. Cash inflows is when the business or the company is receiving money, and cash outflow is when the company or the business is making cash payments. It is losing money. Cash inflow is good for the business, and obviously losing money is bad for the business. And I will simply highlight the most important definitions that you need to know when it comes to the cash flow statement. Now, the first one is a cash flow statement. What is it? Okay, the Companies Act stipulates that a cash flow statement must accompany the company's financial statements. So it is one of the financial statements that every company needs to prepare. That's why you should know about the statement of profit or loss, which determines the performance of the company, the statement of financial position, which actually determines the financial position of the company, and it is divided into three main topics, which will be your assets. And under your assets, you'll have non-current and current. You'll have owner's equity, which is divided between ordinary share capital and retained income. And the third part will be your liabilities, which is divided between non-current liabilities and current liabilities. And obviously, the third statement will be the cash flow statement, which simply determines and identifies the inflow and outflow of cash during an accounting period. The cash flow statement attempts to answer the following questions. Did the company generate enough cash from its operation after paying interest, dividends, and taxation? Did the company raise enough finance for its operations, shareholders, or the lenders to finance its capital expansion? So are we generating enough cash? Are we getting enough cash from the shareholders or the lenders for us to finance any capital expansions? Capital expansion is simply investments into the business that will ultimately result in the company generating more income or cash in the future. Has the company managed to employ its cash efficiently in such a way that it has cash reserves? Now, this one simply asks, are we using our money efficiently for what it's supposed to be used for? Now, when it comes to this question, you should be asking companies like your Eskom, which receives around more than 200 million per year, but we still have load shedding. Are they really employing their cash or managing their cash efficiently? Does it even have cash reserves? Okay. Now, why do we prepare the cash flow statement? Now, cash is considered king, you know that. Okay, cash is king. Cash is considered to be the livelihood of the business. Without cash, honestly, the company or any business cannot operate because there's certain expenses that you cannot incur without actually paying for them. For instance, if you don't pay your employees, it's guaranteed that they'll go on strike, and therefore the business activities will be halted for the duration of the strike. Okay. Lack of cash flow information can result in the performance of a business being misinterpreted. Okay. So if we don't know, I always say, I remember speaking to one of my CA friends, and he was telling me that the biggest mistakes that investors make is just to look at the statement of financial position and to look at the statement of profit or loss and make their decisions based on that. Or else, the most important reason of why they wanted to invest in the first place is to generate cash for themselves. but they hardly look at the cash flow statement. And when you look at the statement of profit or loss, it's prepared on an accrual basis. So you only record income that is earned, you only record cash, you only record expenses that are incurred. You don't record income when it is received, you don't record expenses when they're incurred. So whatever profit you have doesn't equate to the cash that the business has in its bank account. And for you to get dividends, to get your return for investing in the company, you need cash. Because even when the company needs to declare those dividends, it needs to meet the liquidity ratio and the solvency ratio, which requires cash to be available. And for the dividends to be paid, the company can't even obtain loans. So it needs to have cash reserves. However, you don't look at the statement of the cash flow when you make your investment decisions, which is what normally Warren Buffett, the king of investment, um, looks at. He never invests in a company that is highly liquid, well, that is higher risk. A company is considered to be high risk when it has more debt. Okay. And I know in the investment world, they believe that the higher the risk, the higher the return, the higher the risk is determined by how much the company is indebted. Okay. Now, shareholders, creditors, and other stakeholders need to know about the cash position of the entity as it is material in making financial decisions. So shareholders need to know if they will get dividends, creditors need to know if they will get their loan repayments plus interest, and other stakeholders like your trade unions are more interested as to whether the company has enough cash to increase salaries and wages. Okay, and SARS is more interested in whether the company will be able to pay provisional payments plus the third top-up payment, tax payment. So those are the other stakeholders. And then the profits and changes in working capital do not provide sufficient information about the performance of the entity. I've specified that earlier on. Omission of cash flow statement could lead to serious cash flow problems not being recognized on time. There are a couple of companies actually um, that went down due to the fact that they didn't have enough cash. I can't recall them from the top of my head. Okay, now what are the objectives of the cash flow statement? The ultimate objective of the cash flow statement is to determine whether the entity is the net generator or the net user of cash or cash equivalent. Okay, this cash may be generated or used from three activities, from operating activities, and operating activities are the main reasons why the company is in business. These are the main or principal income generating activities. These activities exclude income earned and expenses incurred from investing and financing activities like your interest income, um, financing activities. I can think of dividend income. Yes, a company does earn dividend income by investing in other businesses. Those businesses declare dividends which are paid to the company itself. Okay, I know that is beyond the grade 12 syllabus. Now we also have from investing activities the purchase and disposal of non-current assets, including financial assets like in investments. I know that SAA got into trouble because it sold its non-current asset and leased them back. So it didn't really have, remember your assets determines your future income or your future cash. And if you get rid of your assets, then you're getting rid of your future cash, which is why there's no future in SAA because it doesn't have any assets. I hope that makes sense. Okay. Financing activities are simply determines how the company is financed by issuing shares. Obviously, that will result in inflow of cash by buying back shares that will result in outflow of cash. Remember the reason why we buy back shares, those three reasons. Okay, don't forget those reasons. Very, very important. Okay. Um, Now, long-term financing of the entity, either through equity or liabilities, obviously, shares being equity, liabilities being loans. When we get those loans, when we receive money from the loans, remember that that is proceeds, it's cash inflow. When we make loan repayments, that is a cash outflow. Okay. Now, the cash flow statement enables users to determine how each activity caused the increase or decrease in the cash inflow or the cash outflow. Now, the cash flow statement breaks down how cash was used or generated by the entity, helping the user understand the cash position of the entity. So the cash flow statement basically looks like this here. Okay. It's divided into three activities. I shaded them so that you can see. Actually, it's four activities in total, which is your cash from operating activities. And the cash from operating activities, you have cash generated from normal operations, and then interest paid, dividends paid, as well as tax paid. Interest paid, dividends paid, and tax paid are shown separately because they are material. So we need to know how indebted the company is. We need to know if the company will be able to pay its shareholders. We also need to know if the company will be able to meet its tax um, obligations. And then under investing activities, these are all about investment. Obviously, investment has to do with non-current assets. Note that investments are very important. As I've said, this is the main reason why SAA got into trouble. This is the main reason why ESCOM is in trouble. It's because it didn't focus on its investing activities, okay, which results in inflow of cash for the business in the future. Because they didn't focus on this in previous years, the future, which is now the present, that's why we're in problems that we are in right now, okay. Now we've got proceeds from the sale of non-current assets. Obviously, that's when you sell some of your assets, which is the biggest mistake that SAA made with ESCOM. I think it's all about buying. They didn't purchase enough current assets or even service existing generators, which is why we experience load shedding. Then we've got cash flow from financing activity, which is how is the company financed. Obviously, we have shares, proceeds from the issue of shares, repurchase of shares. We put it in brackets because it results in outflow of cash. We are making payments to the shareholders to buy back the shares. Okay. And then we've got proceeds from long-term loan. This is when we're raising more loans. So when we raise more loans, even though at the moment or currently this might result in cash inflow, we also need to look at long-term repercussions, which is us making the loan repayments, making interest payments and all of those, which will affect our cash flow in the future. And the last one will be net change in cash and cash equivalent, which simply compares your cash equivalents at the beginning of the year with the cash and cash equivalents at the end of the year. You want your cash and cash equivalents at the end of the year to be bigger than your cash and cash equivalents at the beginning of the year, as that means that your cash in the bank is going up. When we talk about cash and cash equivalent, we simply also talk about certain current assets that are considered to be cash. They're highly liquid. I can't think of one right now. Can't think of one right now. But obviously, under cash and cash equivalent, for most businesses, for grade 12, you're going to be having your bank and you're going to have petty cash as well as cash float. Okay. Cash float, I always say the common name or word for cash flow is change. Yeah, change is like most taxi drivers is what they normally don't have in the morning. They don't keep cash flow. Cash float is so that you can be able to give people change if they pay with the notes. And yeah, that is not what the taxi business understands at the moment, because most taxi businesses or drivers do not have cash flow to give to their clients, especially in the morning. Okay. And the flow of cash, the entity generates most of this cash flow from its operations. Obviously, that's why you're in operation, so that you can generate more profits by selling more, which is the main reason the entity is in business. And another way is the entity's operations must generate enough cash inflow to meet its financial obligations. The entity has different sources of financing as per the diagram below. So this is how cash flows, okay, and I will, which is what the name of the statement is. We generate money from our operations, and obviously we use that money to finance our operations. And we use that money to pay for tax as well as dividends. Okay. And we also receive money from loans, and we have to use that money we receive from loans within the business, but we have to generate enough cash so that we can repay those loans back. And then we also generate money by selling shares, but we also need to use that money to repurchase shares. Obviously, use that money within the business And whatever we use it for must generate enough cash to enable us to buy back shares if we feel like we have more than enough money, and for us to be able to make dividend payments to the shareholders. We also will have proceeds from the sale of non-current assets. That must also be done if the non-current asset wasn't really generating enough income, or it doesn't have that much value that will result in future cash inflows. And obviously, we have to generate enough cash for us to purchase more non-current assets if the current ones are not working. And then we've got short-term loan or short-term investments that have matured. Maturity simply means that if you had a loan, if you had a fixed deposit for 5 years and you are in the fifth year, it means that fixed deposit you made 5 years ago has matured. In that fifth year, you are getting your money back. Remember, then this is what the mistake that most people make. When you make an investment into a fixed deposit, let's say my fixed deposit last year was 200,000, and this year my fixed deposit, at the end of the year, my fixed deposit is 300,000. People think that is a cash inflow. No, it's not a cash inflow. When your fixed deposit goes up, it means that you're taking money out of your bank account and you're putting it into the fixed deposit. So it is a cash outflow. If your fixed deposit goes up, that is a cash outflow. If your fixed deposit goes down, it means that if your fixed deposit at the beginning of the year was 500,000 and at the end of the year, your fixed deposit is 100,000, it means that you received money from your fixed deposit, which is around 400,000. That is a cash inflow. Remember that. A decrease in fixed deposit means it has matured. Some of it has matured and you're getting it back. It has expired or matured, it means you're getting it back. It goes straight into your bank account. A fixed deposit is not a bank account, it's an investment account. I hope that makes sense. Don't treat the fixed deposit and the bank account as though it's the same thing. No, they're not the same thing. Bank account is what you use on a daily basis to receive money and to make your payments. A fixed deposit, you don't use it on a daily basis. It's based on the period over which you intend to have that fixed deposit. All right. Remember, when we talk about the cash flow statement, we're only focusing on the materials. Okay, we're focusing on cash. All right. Now, the statement of cash flow is divided into the following 4 sections. I won't explain them because I've explained them already, okay? Obviously, it's between operating activities. Operating activities, to prepare this part of our cash flow statement, we are going to use information from the statement of profit or loss, information from those the financial statements, and information from the statement of financial position. To prepare the investing part of the cash flow, we simply will focus on the statement of financial position more than anything. And to prepare the financing part, we'll also focus on the statement of financial position, where we focus mainly on shareholders' equity. Remember, shareholders' equity is simply your ordinary share capital and retained income, and we also focus on your non-current liabilities. Those represent how the company is financed. And it takes you back to your accounting equation. Remember, your accounting equation is your asset is equals to owner's equity minus your liabilities. Note that the asset part represents what the company owns, and your owner's equity minus your liabilities represents what the company owes. Okay, what we owe. So we owe the shareholders, we owe our creditors, and in return, why do we owe them? It's because the shareholders contributed capital into the business, and your creditors contributed. They basically gave you loans. They also sold goods to you on credit. I hope that makes sense. So it's all about financing. Owner's equity minus liabilities, it's about financing, and your asset part, which is the right hand side of your accounting equation, represents your investments. So you take your financing to finance your investments. That's how it works. And then the last part of your cash flow statement represents your net change in cash and cash equivalent, which is equals to cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities. Please note that sometimes you will add a negative number. Okay. So when you add a negative number, obviously it will be minus. So let's say cash flow from investing activities was a minus. So we will say cash flow from operating activities plus, but you will have minus cash flow from financing activities and plus cash flow from cash flow from financing investing activities, and then you add your cash flow from financing activities. So remember that your net change in cash and cash equivalent is made up of all the other activities, the sum of all the other activities. Okay. Now, notes to the cash flow statement. There's 10 notes that are not compulsory, but are important for you to show them as workings. And one of the notes that is very important is the cash generated by operations, which considers cash from profits, inventories, receivables, payables. But from your payables, you exclude interest, you exclude dividends, you also exclude any non-cash items. Although I have explained why we exclude those three, which is your interest, dividends, and tax. Okay, we exclude those. I forgot tax there. I forgot to include tax, which is very important. And then cash and cash equivalents. We only consider cash and cash equivalents. For this one, we normally use note number 5, if I'm not mistaken, which is your bank, your petty cash, and cash flow. Please note as well that when your bank account is negative, it will not be in cash and cash equivalents. It will be in trade and other payables, or right on the face of your statement of financial position as bank overdraft. So pay attention to that fact, that if your bank account is negative, it will be a bank overdraft, which is a current liability. And now other notes that are not important, but you need to show as part of your workings will be dividends paid, taxation paid, as well as tangible asset paid. I won't read that. It's obvious. Dividends paid, it's all about dividends that we pay to the shareholders, which are in any particular year. It'll be last year's dividends plus this year's interim dividend. Taxation paid, it's all about provisional payments. So you know that the company needs to make 2 provisional payments in a year. If those provisional payments are less than your final income tax, then you need to make the 3rd provisional payments, and that's what taxation paid is all about. And then we've got tangible assets. It's all about when you sell your tangible asset. Here we don't focus on profits from the sale of tangible asset. We don't focus on tangible asset being sold at carrying value. No. We only focus on the money we received when we sold those tangible assets. So we don't focus on any profits. We don't focus on carrying value. We just focus on the money we received when we sold those tangible assets. And obviously the purchasing of tangible assets is money going out when we buy those assets. Okay. Now, focusing on the information required to prepare the cash flow statement, the entity may only prepare the statement of cash flow statement once it has completed the statement of profit or loss, the statement of financial position, and the related notes. And that is very vital information. So the cash flow statement is non-existent without the statement of profit or loss, the statement of financial position, and the related notes. And as I've said, we need all those statements for us to prepare the cash flow statement, and we also need the notes to the cash flow statement to prepare the main cash flow statement. Okay. Now, this is the information that must be kept in mind when preparing the cash flow statement. In every transaction, only record the cash part in the statement of cash flow. And this is what amazes me, because it tells you statement of cash flow. So if it's not cash, it doesn't go there. That's it. And each transaction will result in either cash inflow or a cash outflow. Now, cash outflows must be shown with brackets. Anything in accounting that shows a reduction will be in brackets. We're talking about dividends on ordinary shares. We're talking about your expenses. We're talking about interest expense. We're talking about income tax expense. All of those, anything that results in reduction must be shown in brackets. Okay. Please note that if it's a reduction and there's no brackets, you get no mark. Now, prepare the notes to the cash flow statements before completing the statement of cash flow. Now, some notes may need to be prepared on the face of the statement of cash flow or as part of workings. Okay, that is very important. That's why I highlighted the whole thing. It's very, very important. Okay. Now, guys, note one, which is cash generated by operations, has two parts. Okay, part one will just be focusing on cash adjustments of profit before taxation by adding back non-cash items like your, well, I don't want to say interest. Interest is a non-cash item. We add it back because it must be shown separately on the face of the cash flow. But a non-cash item, obvious ones will be depreciation and amortization. Obviously, as I've said, interest, we add it back not because it's a non-cash item. We add it back because it must be shown separately on the face of cash flow statement or the statement of cash flow, and that is because information that relates to interest expense is very material. Okay. As I've said, these two items have already been deducted from profit before tax. We add them back to eliminate the non-cash expenses. And with respect to interest, just to eliminate it there so that we can show it separately on the face of the cash flow statement. And we normally deduct non-cash income and any interest income, as interest income must be shown separately, as it tells the users of financial statements how much of our investments results in us any interest income. It's very vital for, remember, material information is any information that influences the decision making of stakeholders or any other user of financial statements. Okay. These two items have already been added to profit before tax. We subtract them to eliminate the non-cash income. But when it comes to interest income, it's just to eliminate it so that it can be zero. We can show it separately on the face of the cash flow statement. All the above must be shown separately on the face of the cash flow statement due to materiality principle. When I talk about all the above, I'm simply referring to the number twos. Under expenses is interest expense, and the incomes is interest income. Okay, those must be shown separately on the face of the cash flow statement. Okay. Part two is working out cash generated from working capital. Remember, working capital is in three, which is your current assets. Your current assets will be your inventories, your trade and other receivables, as well as trade and other payables. Okay. So part two only focuses on those three. I will start with inventories. Okay. Increase in inventories means that you bought more. So it results in a cash outflow. A decrease in inventories means you sold more, which resulted in a cash inflow. Okay. So remember these two because it's very, very important. And memorize them if you can. Okay. And when it comes to trade and other receivables, an increase in trade and other receivables is an opportunity cost lost. So an increase in trade and other receivables is an opportunity cost. We lost cash because we sold goods, but we're not getting money, so we lost cash. Okay. And a decrease in trade and other receivables means that people that owed us are paying us back. That's why it is a cash inflow. Increase is a cash outflow, and a decrease is a cash inflow. All right, then we have trade and other payables. Trade and other payables is our current liabilities. If it goes up, it means we saved cash we had due to non-cash expenses. Remember, we always add them, which results in a cash inflow. It means we saved cash. Basically, that's what it means. When it comes to a decrease in trade and other payables. It's bad cash-wise because it means that we paid our creditors, so cash is going down. So the king is going down in that case. Now, use information from the statement of financial position and the notes to the financial statements of the previous and the current year to prepare the second part, okay? The result will be net change in cash, net change in working capital. That is for the second part. And as you remember, net working capital is made up of current assets minus your current liabilities. Okay. Let me just do this quick example for part one. Now, I'm just preparing the first part of your cash generated from operations node. So we've got here, um, we need to calculate operating profit before changes in working capital. So we want the cash component of our operating profit. We are given depreciation. We are also given interest expense and net profit before tax. This is quite easy because now for you to prepare the top part, you're going to take your profit before tax. We want the cash part of your profit before tax. So we are going to add, I'm going to start with depreciation because it's a non-cash item. That's why we're adding it back. We add depreciation because it is a non-cash item. It doesn't result in cash outflow. However, we add interest expense because it must be shown separately on the face of the statement of cash flow. Okay. There are different reasons, two different reasons why these two items are added. Okay, depreciation, we add it back because it's a non-cash item. Interest expense, we add it back because it must be shown separately on the face of the statement of financial position. Why must it be shown separately? Because it tells us how indebted, how indebted the company is. So that information is vital to the readers of financial statements. This will give us the adjusted cash component of your operating profits. And in this case, your adjusted cash component of the operating profit will be 60,000. Let me just confirm that can't be 60,000. It must be 90,000. It should be 90. All right. Try this quickly. Record it. You should be done. You will start with profit before tax and simply add depreciation of 90,000 and interest expense of 32,000, and you will get your cash profits before changes in working capital. I love saying cash profits. That's what it is actually. It will be 280,000. Okay, try this one out. Your time is up. So you have profit before tax as 900,000. You add depreciation because it's a non-cash item. You add interest expense because it must be shown separately on the face of your statement of cash flow, and you will get your cash profits before changes in working capital, and that will give you, let me just confirm here, actually all these values here are incorrect. Let me just correct them quickly. Please be on the lookout for the next video. We will be focusing on part one as well as part two. Okay. Please make sure that when it comes for you to be able to understand the statement of cash flow, make sure you watch from video one up to the last video. Okay. And yeah, with that knowledge, you should be able to use this part. Hold on for now.